Go ahead and kick off the introductions. First of all, thank you for joining our webinar today. My name is Gina Buckles. I am one of the advisors at 401k Plan Professionals. And of course, today we're going to be covering understanding your 401k plan fees. So I'll break it down to the different types of 401k plan fees, how 401k plan fees are paid to those different parties, and then what we do to benchmark your 401k plan fees. It's been an interesting landscape over the last 10 years. The conversation of 401k plan fees, it's definitely picked up. It's definitely changed. I know about 10 years ago, there was a survey done and they asked 401k participants what their fees were. And 70% of people thought there were no fees in their 401k plan. So clearly, and I think because of that, the IRS and the Department of Labor said, we've got to be more transparent with fees. So obviously, as many of you know, we have fee disclosures and we have to distribute those fee disclosures. I did an unscientific survey of all of our clients' fee disclosures, and I found that the average fee disclosure is about 16 pages long. So I think we went from people thinking there were no fees at all to completely confusing people. So hopefully today we'll make this conversation provide you with a little bit more clarity, whether you're a business owner or maybe you sit on the plan's fiduciary committee. We're not trying to make you experts. Obviously, that's why you have us. But again, I hope that this at least helps you. If you look at a fee disclosure, you can understand and translate that a little easier than maybe you could before today. So for those of you who may not be familiar with our webinar series, we typically do about one webinar every single month. They're on a variety of topics. They're generally about 30 minutes, and I'll try to be respectful of that today. You will receive a recorded link, and you're welcome to share that with anyone. If you sit on a plan committee, great thing to share with other committee members who maybe can't join us today. Also, check out our website at 401k Plan Professionals or our YouTube channel. There's some great stuff out there. We just released the plan sponsors hot topics, and Jenna just finished our video series on 8 steps to financial wellness. That's a great thing to share with your staff. And again, this is our team. Again, thank you for joining. Jessica, Jenna, myself. We recently just added Virginia Ryan. And of course, Kristen Carlin is our marketing director, and she's kind of the mastermind behind all of these webinars. And if you're not familiar with 401k Plan Professional, of course, we do much more than just host webinars. We do a lot of fiduciary services listed there, as you can see, including benchmarking and helping you decipher your fees. And of course, education is a passion for us. We provide a lot in the way of employee education as well. So we will go ahead and jump into our 401k plan fee webinar. And the first thing to understand is who gets compensated on your 401k plan. And this is something I always try to break down in committee meetings. There's generally 3, maybe 4 parties who get paid on your 401k plan. So first of all, you have your 401k plan record keeper. So very simply, they're the ones that track the money. That's who you send the money to. They pay money out to people who've terminated or retired. They probably have a fancy website, a cool mobile app. They may also do your compliance piece as well. So they may be the ones who draft your plan document. They may be the ones that prepare your IRS Form 5500 and your discrimination testing. So that's your record keeper. And that may be Vanguard, Fidelity, ADP, but that's their role. And obviously they get paid. And then, of course, you have the investment managers. That's the mutual fund manager. So in your 401k, you have a menu of mutual funds. The investment managers, they manage the mutual fund. So they get paid. And of course, you have the financial advisor, which in most of your cases, you've hired 401k Plan Professionals to be the financial advisor. I already kind of showed you a lot of the services that we provide to you, but we get paid as well. And then some of our clients will also use a third-party administrator. So they'll take some of the roles and responsibilities from the record keeper, like the IRS testing, plan documents, discrimination testing, things like that. They'll take that off the plate of the record keeper and they'll do that. Typically, we find a TPA is necessary or very helpful if our clients have a very complex plan design. Or if they have a very complicated profit sharing allocation, in that case, a third-party administrator is very valuable. But again, a lot of our clients, the record keeper does all of those services. So you will definitely have 3, perhaps 4 parties who get paid on your 401k plan. So hopefully that alone helps. And how do they get paid? So this is where it can get a little complicated. But one very common way to pay all of those different parties is to have their compensation deducted from the investment returns. That's called an expense ratio. That's how the investment managers get paid. Every mutual fund has an expense ratio, and that's how the investment managers, that's deducted from the investment return, and that's how they get compensated for managing that mutual fund. We may also add an asset charge, which is also deducted from the investment returns, and that asset charge can be used to pay the financial advisor and the record keeper. So in that scenario, all of the fees come off the investment returns. So if you, as a plan participant, see an investment return of 7%, you know that that's after the fees have been paid. So generally, when you look at your statement and you go online and you see your investment returns, generally that is net of all of those fees. Of course, you might need to read the fine print to make sure that it is net of all the fees, but generally that's the case. Now, it's also important in this discussion of 401k plan fees that you understand share classes. And you may have noticed, if you've ever looked closely at the mutual funds in your 401k plan, that there's a letter or a number after that mutual fund. And some of the mutual funds that we use are what we call zero revenue sharing funds. And examples of that is an R6, a K6, a Z. There's some other no revenue sharing funds. But whenever you see that term, if you see an R6 or a K6, that means the expense ratio you see, that is only paying the investment manager. There is no extra revenue in that mutual fund to pay other people. So it's very clean, it's very transparent. I'll give you an example of that. I'm kind of a visual person, so maybe this will make sense. This is one of our clients who uses a zero revenue or no revenue sharing mutual funds. So the entire platform is made up of zero revenue sharing funds. So here's an example. Let's say I am invested in the Fidelity Freedom 2040 K6 mutual fund. That means this expense ratio over here, 0.49, is what Fidelity gets paid to manage my mutual fund for me. That's it. Nobody else gets paid in that 49 basis points, only Fidelity for managing it. Now, of course, we know that the financial advisor and the plan record keeper need to get paid as well. So that is what this asset charge is. So this 45 basis point or 4.5% is used to pay the financial advisor and the record keeper. And from there, we also break this down and provide more clarity in committee meetings. In this example, I can tell you that the financial advisor fee is 20 basis points, the record keeper fee is 25, and that's how we get to an asset charge of 45. But that's very easy, very clean, very transparent to understand. But in this case, and this client does not have a TPA, in this case, all of the fees are deducted from the expense ratio, or at least the majority of them. We'll talk about some transactional fees, but again, the majority of the fees are deducted from the investment performance. So let's talk about some of our clients use revenue sharing funds. These are represented by A shares, R shares, R3, R4, R5. If you ever look at a mutual fund and you see one of these share classes, that means that that expense ratio, that includes some revenue, and that revenue is going to be used to pay your record keeper and or your advisor. So give you an example of that. This is another one of our clients that has a revenue sharing mutual funds. And here's an example where they have R2 or an iShare class. And this just lists one single expense ratio. One single expense ratio. But within that expense ratio, 3 people are getting paid, 3 parties are getting paid. The investment manager, the record keeper, and the advisor. This is where it gets tricky. How do you know how much each of those parties are getting paid? Well, that's usually when you might want to call me or Jessica or Jenna or Virginia, because we can kind of dig in. And again, this is all disclosed in a fee disclosure. It's just sometimes difficult to dig it up. So if you do use revenue sharing funds, you'll find on your fee disclosure or on your provider website that it will break that fee down. So here's an example. This is one, an R share class. The expense ratio is 99, but we also know that there's revenue sharing of 50 basis points, 12B1 fee, and then the servicing fee, that's what the record keeper will keep. So that has 65 basis points that's getting paid to other people. So 99 minus 65 is 34. So that means the mutual fund is keeping 34 basis points, and the advisor and record keeper is getting paid from this. So again, it's a little harder to dig that up and distinguish. But again, as advisors, we're pretty good at looking at fee disclosures. We can help you find this and explain it to you and how it applies to your plan specifically. So again, revenue sharing funds can just be a little bit more difficult, take a little bit more digging to figure out who gets paid what. Now, a couple other things that you should consider when you're thinking about, different fund share classes. Zero revenue sharing funds, as I showed you, it is very transparent. They're more easily replaceable because we don't have to consider how much revenue is in that fund before we replace it. It doesn't necessarily mean that they're better or they're always the least expensive. As plan fiduciaries, we and you, if you're a plan sponsor or you sit on your investment committee, we always want to do what's best for the plan participant. That's above all the most important thing that we need to do. And we need to always try to use the lowest cost share class. So sometimes we'll talk to our clients and they have revenue sharing funds and we think, gosh, maybe we should look at some zero revenue sharing platform. But in that analysis, we might find that it's actually cheaper using the revenue sharing classes. That we might be using the most efficient share classes, and therefore it might behoove us and be in the best interest of the plan participants to keep a revenue sharing platform. So again, doesn't necessarily mean one is better than the other. Definitely think zero revenue sharing funds are more transparent, but that's an analysis that we can help you with. That's an analysis we've done for a lot of our clients. If they have revenue sharing funds, we'll often take a look at, hey, what would your fees be if we moved to zero revenue sharing funds? And would that be in the best interest of your plan participants? The Department of Labor, I always say this, and I've said this many times in committee meetings, they don't say that you have to have the cheapest 401k plan. They obviously want you to use the lowest cost share classes that you can, but they really want plan fiduciaries to understand their fees, to know what their fees are, and be able to benchmark and deem them to be reasonable for the services that they get. And again, that's what we do as advisors. And I'll talk a little bit more about how we go about benchmarking your fees. So again, you don't have to have the cheapest 401k, but you do need to know. A couple other things that I wanted to mention, there are some other ways that plan sponsors can pay their fees. So some plan sponsors, especially our clients that use Vanguard, they have their fees deducted from participant accounts. So that means their expense ratio is only the expense ratio, and there's no added revenue, there's no additional asset charge. So their investments are very, very low cost. But the fee gets spread out generally pro rata against all participants in the plan. So I'll give you a quick example. Let's say Vanguard, their record keeping fee is $5,000 for your organization, for your 401k plan. And let's say you have 50 employees in your 401k. They would simply spread that $5,000 cost among all 50 employees, and they deduct it from their account on a quarterly basis. So again, Vanguard is a very typical provider that we use that uses this way of collecting their record keeping fees. It's very transparent because your participants can see that fee deducted on their statement or on the website. And again, it's just everyone is sharing on a pro rata basis the record keeping and perhaps even the advisor fee. So that's another way to do it. Also, what we're seeing a little bit more now is the Department of Labor and the IRS, they came up with some ideas and some incentives to get employers to start a 401k, and they're giving some pretty hefty tax credits. In fact, there's some legislation out there that will give employers who start a 401k plan a $5,000 tax credit for the next 3 years. So some plans that are just brand new, maybe a new company, they want to start a 401k, they can get some pretty significant tax credits. And oftentimes for those employers, it would behoove them to just pay the fees directly. They just write a check to their provider. They write a check to their financial advisor. And then again, oftentimes they can get a tax credit to offset those administrative costs. We also have some employers that just feel like, you know what, as an added benefit to our employees, we'll pay it. We'll pay it. We're okay paying it. And that just lowers their costs and their retirement plan. So that's also something that we see probably more typical in recent years as well. So that's another way to pay it. And also, I just want to mention different parties can get paid in different ways. Some of our clients, let's say they use Vanguard, they'll say, you know what, we're going to take the record keeping fee, we're going to deduct that pro rata from all of our participants. But for 401k plan professionals, as our advisor, we're just going to write you a check. And that's okay too. So obviously we can structure these in a lot of different ways, and whatever works, best for you. So those are a couple other scenarios I wanted to mention. And then, of course, there are some additional fees that you may see from time to time. A perfect example of this was that Cycle 3 plan restatement. I hope I'm not talking Greek when I say that term. Hopefully, many of you have seen that in your email. Every 7 years, you have to restate your plan document. This is a huge undertaking for record keepers who write the plan document, because what they have to do is update that plan document for all the legislative changes that happened since the last restatement 6 or 7 years ago. And so they're going to pass on some of that cost to you. So you may have gotten a bill recently. So they could, because this year, 2022, it was restatement year. There'll be another one in like 2029. So about every 6-7 years, you're going to have to do this. And there's generally an additional cost. So that's something that most of our clients just paid, via a check or paid directly to the record keeper who was rewriting that plan document. Those fees are maybe $1,500. That's kind of the ballpark of what we saw those fees. And then, of course, there's maybe some administrative or transaction fees. A lot of these fees are incurred by the plan participant. So maybe you don't see them as much, but they are listed in that fee disclosure. So a good example, a distribution fee. If you're a participant in the plan, you leave, you no longer work there, and you want to move your money out of the plan, they may charge you $50 to process and cut that check and mail it for you. If you take a loan out of your 401k, there's a fee to do that as well. That's deducted from the participant account. But again, it has to be disclosed and it has to be listed in that fee disclosure. So those are some examples of some other fees that we'll often see and will be pretty transparent, pretty easy to see in the fee disclosure. So since I've mentioned fee disclosure so many times, I do want to mention a couple of things about that fee disclosure. I know I made a joke early on that the average fee disclosure is about 16 pages. That was my unscientific study, but it's very lengthy. And in that fee disclosure, it's kind of a two-part disclosure. It will show the plan and individual fees, and then it'll also show the investment information. It'll benchmark past performance. It'll show all of the expense ratios on those mutual funds, if there's any trade restrictions. And again, any other fees for distributions, loans, any other type of transactions. If you amend your plan, there might be an amendment fee that you have to pay, but all of that will be, in these fee disclosures. With regard to the participant, that fee disclosure obviously is only the fees that they would incur, not fees that the plan sponsor might incur, like that Cycle 3 plan restatement. But it is very extensive and it's very long, and I can certainly understand why a lot of 401k plan participants don't read it. They will sometimes call us and ask us to decipher it for them, and we're always happy to do that. A couple things with regard to that fee disclosure. New plan participants should get that fee disclosure 90 days from the date that they've become eligible. Some of you use providers that will automatically send that fee disclosure to them, which is very nice. In addition to that, all plan participants have to receive an updated notice on an annual basis. So you'll typically find that once a year, your record keeper will send you an email and say, hey, your new fee disclosure is ready. Please distribute this. And yes, you can email it. Please distribute this to all of your plan participants. And that's anybody in the plan. So the other option, of course, is many record keepers will say, hey, if you'd like us to take that off your plate, maybe unburden you some, we'll do it for you. We'll mail those disclosures out to everyone that we have on record and to the address that we have on file. So that's a really nice service. If you find those disclosure requirements are becoming very tedious and burdensome, you might want to ask your record keeper or reach out to us, and we can help you kind of talk through what the additional costs would be and if that would make the most sense for you. So let's just talk about one last thing. And again, in committee meetings, part of every committee meeting we do is we help benchmark your fees. So we like to break it down in those different pillars for you. Here's what your record keeper gets paid. Here's what your advisor gets paid. Here's the investment management cost. So we in every committee meeting, that's part of our meeting, it's part of our agenda, and we're going to break down your fees for you. So if some of this sounded overwhelming, don't worry, we try to make it as easy and understandable as possible at every committee meeting. We subscribe to an organization called Fiduciary Decisions, and this provides us with a report that we can use to compare your plan fees to the fees of other plans with similar assets and a similar number of plan participants. So that's important. That's kind of the benchmark that we would use. The other thing that's very helpful when we talk about this in committee meetings, it also reminds all of us as fiduciaries, if your fees are getting deducted as an expense ratio or an asset charge, understand that as your plan assets grow, people they get more money. So if you have an asset charge and your plan started at $2 million and now it's $8 million, we need to negotiate with the record keeper, and we also lower our fees as well as the plan assets grow. So that's something that we talk about. And again, we negotiate with your record keeper as your plan assets grow to make sure that, what they're getting as revenue doesn't get too out of line or outside the range of what we deem as reasonable. The other thing that we'll do from time to time with our clients is we'll take your plan, what we call out to market. We'll get bids from other record keepers, generally about every 3 years. So we may have done this for you. We may have talked about it in committee meetings. We'll, get 3 or 4 different pricing proposals, and we'll compare that to what you're currently paying. So it gives us an opportunity to make sure that everyone's, again, that your fees are, within the range of what we would deem to be normal. Again, the Department of Labor says you don't do that all the time, but every couple of years, you should probably go out to the market and just make sure that you really can say, you know what, based on the services we get, we're comfortable with our fees. So I want to just show you a quick example. I know this is really small print, but if you've ever sat in one of our committee meetings, if you're a fiduciary and you join us for that annual or semi-annual fiduciary committee meeting, this probably looks familiar. And this is an example of one of our clients. They're with Fidelity. They have a plan that's about $8.5 million. So you can see that we benchmark that, for 2 other plans that's about the same size. About the same number of participants. And this gives us a range of about 112 different plans that we can compare their fees to. So that's a good benchmark demographic. And it would show us that the average fee for plans your size or plans this client size is somewhere between 20 and 45 basis points. I'm sorry, that's the record keeper. That would be the record keeper fee. So we can say, okay, well, you use Fidelity, their record keeper fee is 25. And yeah, that falls, definitely within the range, even on the low side of the range. And then we can also benchmark our fee as advisor. And that's something we're really proud of. We want to be very transparent with our clients. And so every committee meeting will remind you, our fee is 25 basis points. That's where we fall on this range. And it keeps us honest and make sure you're comfortable, with the fees that we get as well. So we can kind of break those fees down, get an average range. And again, as a committee, we can say, yeah, we feel pretty comfortable that those are reasonable. The other thing that we do as good fiduciaries is we always include that fee discussion and what your fees are in our meeting minutes. The Department of Labor likes that. So we're going to document that conversation. So I hope that, I just gave you a fairly high level of what we look at, when we're talking about fees and we're analyzing and benchmarking your fees. I'm going to just pause there real quick. If you have a question, please feel free to submit it through the Q&A. I'm happy to answer any questions that you might have. Otherwise, like I said, you can reach out to us directly. If this made you think of a couple of questions, just reach out to our team directly and we can give you a more specific answer based on your plan and your fee structure. So I'll keep my eye on that Q&A. While I'm doing that, I do also want to give you a heads up on some upcoming webinars. We've got one in September addressing the retirement gap using voluntary pre-tax deferral. That'll be a really interesting one. Casey Roos with Roos and Company will be presenting. We'll talk about stable value funds in October. And then Jenna has another quarterly fiduciary training in November. And those have been really popular as well. So she touches on plan fees and that, but it was really the result of that fiduciary training that made us realize maybe we need to have a larger conversation of how retirement plan fees work. So she will touch a little bit on this, but hopefully today's webinar gave you a little better overview of how plan fees work. And again, reach out to our team, Jessica, Jenna, Gina, or Virginia. We're always happy to answer any questions that you have about your 401k plan. So with that said, I don't see any questions in the Q&A, but I will hang out just in case there is. Otherwise, have a fantastic day. Hope you've all had a great summer and really appreciate your time this morning to join us.